Have you ever clicked the buy button only to realize you entered the trade too early? Or perhaps you watched the market reach your ideal entry price where you weren't at your computer and you missed the opportunity completely. These situations happen every day and they are often the result of not understanding forex market order. The truth is, successful traders don't just know what to trade, they know how to enter the market at the right time using the right order type. In today's video, I will explain the major types of forex market orders, when to use each one, and the common mistakes beginners make. By the end of this lesson, you will know exactly which order fits different market situations. Let's begin. Don't forget to like, subscribe, share, and turn on the notification bell so that you get notified of subsequent forex lessons in this channel. Do well to drop your comments. I would like us to interact. So what is market order? If I may say, market order is the simplest type of forex order. Market order can be called instant market execution. Some can call it some brokers you will see on their platform instant execution. You could see market execution. So you see market order and what have you. It tells your broker to execute your trade immediately at the best available market price. So example, let's say maybe Euro USD is trading at 1.1050. You believe the price is about to rise, so you click buy. Your trade is opened immediately or very close to the current market price. Depending on market conditions, the exact execution price may differ slightly because price can change rapidly. When you use it, that's instant execution or market order, instant market order or instant execution, you want to enter immediately. You don't want to wait for another price level. The market is moving in your favor and timing is important here. So, things to remember when you want to instantly enter the market. Market orders are fast, but during periods of high volatility or low volatility, your execution price may differ from the quoted price. The difference is known as slippage. So in a jiffy, let me explain what slippage is. Slippage is the difference from your expected entry and your executed entry. The market is moving, is here, and you click to buy here or to sell here. And at the end of the day, you are not executed at this particular price. You are executed a bit above or a bit below the price you wanted to, or where the market was when you click buy. It's called slippage. And most times it's due to volatility in the market. Most times it's due to broker difference and all that. That's why the bio of this video, you will see a link to my broker HFM. I've used them for years, more than 5 years now, and they've been on point. What if the current price isn't where you want to enter? Instead of staring at your screen all day, you can tell your broker, open my trade only if price reaches a certain level. That's exactly what pending orders do. There are 4 major pending orders every trader should know: buy limit, sell limit, buy stop, sell stop. Okay, let's look at buy limit order. A buy limit order is used when you expect price to fall first before continuing upward. Price fall first before continuing upward. Fall first before continuing upward. Example, let's say the current price of Euro USD is 1.1050. You believe the market will retrace to 1.1020, then continue rising. Instead of buying immediately, you place a buy limit order at 1.1020. If the price drops to that level, your order is activated automatically, whether you're on the chart or you are not on the chart. Think of it like this: you're waiting for a discount before buying. Do you get? Most times traders use it to get the best possible or cheaper price. Instead of buying high, maybe you know this market will continue going higher, but you want to get a better price lower. So you wait for it to come down, and then by then you fix your order here. So whenever it comes down, your broker have seen that instruction that I'm buying here. So whenever this market comes here, it picks you and then takes you up. Let's look at a sell limit order. A sell limit order is the opposite of a buy limit order. So while a buy limit order follows the concept of retrace and rise, a sell limit order follows the concept of, you get, buy and then drop. Now, you expect price to rise first in sell limit order. You expect price to rise first, reach a resistance level, and then fall. Let's say, for an example, the current price of Euro USD, let's say, is 1.1050. You expect price to climb. Watch the difference. You expect price to climb to 1.1080 before reversing downwards. You place a sell limit at 1.0180. Sell limit at that level. So if price reaches that level, your sell trade is open automatically. You don't need to be online. You don't need to be watching your chart. You don't need to. These orders are being used, especially maybe you are not really that of a scalper, or even if you're a scalper, you don't have that time that day to stay on the chart all day long. You place those orders and go about your daily business. And at the end of the day, you see your trades being executed automatically. So in the sell limit order, it follows the concept of selling after a rally because you expect a reversal. Let's look at buy stop order. Buy stop order follows the concept of breakout trading. Sometimes traders don't want to buy at a lower price, just like using the limit orders. Most times traders don't want to buy at a lower price. They want confirmation that the market has enough momentum to continue going higher. For instance, let's say the current price of Euro USD is 1.1050. A strong resistance level sits at 1.1080. Instead of buying now, you place a buy stop at 1.0180 at that resistance level. The reason why you place it there is if price breaks above resistance and reaches your order level where you placed your order to enter the market and buy, your trade is triggered automatically. So this strategy now follows and aims at join a potential breakout rather than predict. It follows the concept. Let me bring it down to a layman's understanding. It follows the concept of, let's say you're waiting for a school bus or you're waiting for a vehicle somehow, and that vehicle you missed the vehicle. Maybe before you could dress and come out of the house, the vehicle have passed your junction. Now you walk down few kilometers away, maybe using another route. You go and wait for it because you've had the information that it has not crossed so particular junction. You go ahead to wait for it, and then it comes, passes the next junction where it's meant to, and then meets you. You join it, and then you keep going. That is an example of buy stop order. You wait for the market, you stay in front of the market. Your order stays in front of the market. While the market is here, your order comes here, and then you join it up. Then let's look at sell stop order. A sell stop order works the same way, but in opposite direction. For instance, let's say the current price of Euro USD is 1.1050. Support is located at 1.1020. Okay. You believe that if price breaks below support, it may continue falling. So what do? You place a sell stop at 1.1020. If the market reaches that level, your sell order is activated automatically. This order is commonly used by traders who want to participate in bearish breakouts. Now let's look at another type of order most traders don't see as market order types. This type of orders is called stop loss and take profit. No matter which type of order you use, every trade should have a risk management plan. Every single trade. Before you go into the trade, you should know your risk to reward ratio. You should have your risk patterns, risk strategies in place as you are going into every trade. I've told you, your risk management plan is more important than your reward management plan. You have a strategy that delivers you 1:10, 2:10, or 1:50, or 1:2, 1:3, depending on what that strategy is. Focus more for longevity's sake. In order not to blow your account, focus more on your risk management plan. So in that case, we look at what is called stop loss. A stop loss is designed to close your trade if the market moves against you by a predefined amount. It helps limit potential losses. What do I mean by stop loss? Stop loss is a kind of order in which when you take your trade, you tell the market that in this trade I've gone into, I'm only willing to sacrifice so amount of my account balance as loss. You apportion a certain amount of money from your account balance and tells the market, my order is once this trade goes against me and I'm on loss, once I have this amount of loss, please close this trade. Take me out with this amount of loss. Let's take, for instance, if you are in a trade and then let's say you have $100 in your account. Let's say your stop loss, you're only willing, that your $100 account, you're only willing to lose $10. So you move your stop loss to $10. When you move your stop loss to $10, market sees is an order. You've ordered the market that, you see, if this market goes against me and I'm going to lose in this market, may I not lose nothing more than $10 from my $100. Because if you don't put that stop loss, mind you, the whole $100 will be wiped out if the market keeps going against you. So stop loss order is a very important order you need to use to manage your risk. So, and different traders, the last video we dropped on this channel told us about risk appetite, which you need to go through to know what risk appetite is, so that you know how much you are willing to lose in every particular trade. Now let's look at take profit. Take profit is an order, and take profit automatically closes your trade once your target price is reached, allowing you to lock in gains without constantly monitoring the market. So take profit is the opposite of stop loss. While you are telling the market that if it gives you loss to this certain extent, it should take you out with that loss you've apportioned for it. The same thing with take profit. You are telling the market, if you go in my direction and you give me a certain level of profit, close me at this particular profit. Let's look, for instance, you have a $100 account and then you took a trade. And then you've told the market, I want, maybe let's say your risk to reward ratio is 1:2. You've told the market that, okay, my stop loss will be $10. So if this market decides to go against me, once it gets to -10, close me out. Whether I'm online, whether I'm not online, whether I'm on chart, whether I'm not on chart, it will automatically close you. Even if your laptop, your iPad, your phone, your smart device, your trading device is down, is broken, is missing, as far as those orders exist in the market, it will automatically do that. That's why they are called orders. Now, that's for self-stop. That's for stop loss, right? Then for take profit, you're using risk to reward of 1:2, right? Now, since your risk is $10 minus 10, your reward is plus 20. So you're telling the market that once you go in my favor, in my direction, and gives me $20, please close me out and take me out with that profit of $20. Do you get? So at the end of the day, market goes in your direction and hits your take profit, it closes you out with that $20. So whether you are on your chart or not, when you come in, you will see your account balance will change from $100 to 120. But if you hit your stop loss, your account will drop by 10. It will now be 90. These orders, the take profit and stop loss orders, they are not entry orders, but they are essential tools for managing every trade responsibly. They are exit orders, if I may call them. So which order should you use? If you may ask, which order should you use? Depending on the situation, the best order to use. If you want to enter immediately, use instant market execution as instant market order. You want to buy after a pullback, use buy limit. You want to sell after a rally, use sell limit. You want to buy after an upward breakout, use buy stop. You want to sell after a downward breakout, use sell stop. So choosing the right order depends on your trading strategy, how you expect the market to behave, not on emotions or guesswork. So don't use emotions or guesswork to choose the right strategy or to know them. No, 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 no. If there's one lesson to remember today, is this: don't let the market control your entries, plan them. The right order type helps you execute your strategy with discipline. It doesn't guarantee a winning trade, but it allows you to enter the market according to your time, your trading plan, rather than reacting impulsive. Master these order types. Combine them with proper analysis and risk management, and you will be building the habits of a more disciplined trader. If this video helped you understand forex market orders, give it a thumbs up, subscribe to the channel, and turn on notifications so you don't miss our upcoming forex lessons. In the comments below, tell me, which order type do you use most often? Market orders or pending orders? Me, I use pending orders often, very much. Like, I use instant executions. In a month, I might have used instant executions once or none. Okay. And if you are new to trading, let us know which one you will practice first. Yes, I would love to know that. Thanks for watching. Stay disciplined, keep learning, and I'll see you in the next forex training session. Thank you.